Today we're going to talk about anti-ESG ETFs from a firm called Strive Asset Management. And when we first read about these, we thought they were some sort of inverse ETF, but they're actually much more interesting than that. So before you watch this, if you don't have a general understanding of what ESG is, we've put together this video titled ESG Investing Exposed, and I'll put a link to that in the description of this video. ESG stands for environmental, social, and governance. And in that video, we point out a lot of problems with the opaque methodologies that are used. And then this video to the right of that on the acronym DEI, which stands for diversity, equity, and inclusion, that deep dives into a realm that we think is particularly damaging to shareholders. And when you look at ESG investing, ESG requires companies to spend money and resources trying to meet whatever set of opaque targets they've set that, of course, differ based on providers. So there's money that goes into that, and entire departments are now being created that cater to ESG targets that are impossible to achieve. So companies that ignore ESG reduce costs. So that's the first good thing. Second, this whole notion of DEI is particularly dangerous because when you use criteria other than merit when you're hiring, that means the quality of your talent will be eroded over time. Furthermore, people who are particularly talented will avoid environments that reward and promote using criteria other than merit. So companies that ignore ESG will win the war for talent. The problem is that most companies are embracing ESG left and right. So one example here is the Business Roundtable, which is a nonprofit lobbyist association in D.C., whose members are CEOs of major United States companies. I put some examples on the right there. There's 180 companies at least that belong to this association, and here you can see the sort of policy perspectives that they're interested in, and I've outlined some here. Of course, you see the DEI rubbish, this notion of addressing racial equity and justice, again, that kind of rolls into that. The state of immigration, these are political topics that you're looking at here. They're nothing to do with what these companies ought to be focusing on, which is execution. Now, I've highlighted here purpose of a corporation, and here's what's quite interesting that happened over 3 years ago now. The Business Roundtable decided to redefine the purpose of a corporation to promote an economy that serves all Americans, and 180 companies signed this. And here we've spelled out the new corporation. And on the tin, these things look favorable, but when you start digging in, you see that they're anything but. And I'll give you an example here. You notice how shareholders at the very bottom of the list there. Give you an example on the third bullet point here where it talks about dealing fairly and ethically with our suppliers. Well, there's a lawsuit that's happening right now with McDonald's, and it's nothing short of extortion. So the courts have ruled that McDonald's will have to defend itself against a $10 billion lawsuit from this quote-unquote media mogul, Byron Allen. He alleges that McDonald's doesn't advertise with black-owned media. Of course, he has himself black-owned media. You can see here at the top that he settled a racial discrimination lawsuit with Charter Communications already, and now he's on to the next victim. And you can read the definition here of extortion, the practice of obtaining something, especially money, through force or threats. That's essentially what he's doing. And he says here, this is about economic inclusion of African-American owned businesses in the U.S. economy. McDonald's takes billions from African-American consumers and gives almost nothing back. So this individual is exhibiting despicable behavior that other incompetent business owners who feel the world owes them something will now start jumping on the bandwagon and suing businesses that don't give them money for whatever reason. It doesn't matter. McDonald's is free to choose whomever they like, and based on the character of this individual, it's pretty clear why they didn't engage in business with him, and now he's going to take it to the court. So as McDonald's engages in public self-flagellation about how they can do better, we can't help but wonder, why are these 180 companies so interested in signaling to the world how virtuous they are? And here's the answer. So we did a piece titled, What Institutional Ownership Really Means. And if you don't know the difference between passive and active investment management, just give that piece a read. I'll put a link to it in the description of this video. Well, the big three that we're going to talk about, BlackRock, State Street, and Vanguard, they're the largest shareholders of 88% of S&P 500 companies. They control over $20 trillion in equities. Why is that? Well, it's because they build ETFs that track indices, and they're passively having to invest in these companies for no other reason than they need to track the performance of them. So you can see here on the lower right there, the growth of the big three. That's their assets under management in trillions over time, and you can see how much influence they have. On the left-hand side here, you can see almost the exact same headline there coming out in the same year about how they want to boost racial diversity in an attempt to hire on a criteria other than merit. Now, there's a much bigger problem here, and it's that the big three have significant voting power and influence because of their passive ownership. Now, that influence isn't necessarily exerted via proxy voting, where they actually vote on issues that a company presents to shareholders. What's happening is they're doing something called shareholder engagement. So a lot of large public companies now have hired large departments whose full-time job is to deal with this shareholder engagement from large asset managers, the clients of the big three, on ESG-related matters. And CEOs of these companies are now being pressured to adopt social agendas, and academics last year found that many of these companies effectively just cut and paste the language directly from BlackRock's letter into their SEC filings about all the great stuff that they're doing. Now, enter into the picture the solution. The company that we've been waiting for, called Strive Asset Management, is building ETFs that do something very different. So you can see here we've highlighted, they've put together, we're just going to talk about one ETF today, this Strive 500. So it's correlated to the S&P 500, nearly 100% correlation there. And their plan is to mandate companies to focus on profits over politics and ESG in the same way that BlackRock is doing the opposite. So they're going to engage in active shareholder engagement with C-suites and boards and better align proxy voting with client interests. Look at that fee. So it's 5.5 basis points. This is competitive with the other passive index providers. So there's no reason not to invest in this, because you're not paying any additional fees to have them act in the best interest of shareholders, which is to pursue excellence over politics. Now, Strive is engaging with the companies they're holding, and last month they started this campaign where they've identified 7 American companies with untapped potential if liberated from ESG imposed constraints. You know, Amazon, Apple, Chevron, Disney, Exxon, etc. The founder of this, if you're familiar with the Ant series of businesses, remember Roy Vaught and all those, we've covered them in the past, but this is the gentleman who is behind those biopharmas. And if you think about activist investors, maybe they'll start to emerge and focus on these broken tech companies. So can you imagine the sort of bloat over at Google, and what's happening right now at Twitter is, if you pay closer attention to what's going on there, you can see just how much absolute bloat there was in that company. People with jobs that did essentially nothing, and it's all this focus on building environments where everybody feels safe and included. That's not how you manage high-performing teams, and we've discussed that in our piece on DEI. Now, Strive's report card for corporate America, here they give a couple examples of damaging corporate behavior, such as Apple's shareholders supporting a racial equity audit, whatever that is, against the board's recommendation. So the board doesn't even control the company anymore. Activists have taken that over. So on the right-hand side, they've put some positive corporate behaviors where you see Netflix is prioritizing artistic merit over politicized employee demands. That's great. You shouldn't let your employees take you hostage. Like, you should be dictating what the employees work on. So the other example here being Coinbase. We've praised Brian Armstrong on numerous occasions because he's chosen to reject calls for corporate social activism as a source of distraction and internal division that is spot on. So how's it going for Strive? Quite good, actually. So they're offering these index funds that are nearly identical to those offered by the big three. Their AUM surpassed $500 million in 3 months since they launched their first fund. That's pretty good. That's a fairly quick accumulation. All 7 of their ETFs are becoming available on some of the largest 401k provider platforms in America. That's great. So you can log into your 401k account and quickly change your allocations, and suddenly you're putting your money where it should be, which is a focus on excellence. And Strive has now come out with 4 more ETFs. We're not going to get into these. We may look at them in a future piece because this model is quite interesting. But just to conclude, regardless of your political inclinations, we should all be able to agree that companies should focus on maximizing shareholder returns. And if you don't believe that, there's at least 6 different opaque ESG strategies that you can choose from. Those who do believe in excellence over politics should start voting with their wallets. So we did a piece recently on Asian ETFs funds and European funds, and it will be interesting to see if Strive comes out with some alternatives from Vanguard. We really like Vanguard because of their low fees. Be more vocal about behavior that serves to cripple some of the world's biggest companies. Not enough people are talking about this, and they need to. So, and on our last piece, we had a lot of great feedback from people that said, finally, somebody's saying what we're all thinking. So Strive's ETFs are helping to shine the light on what matters. So please let us know what you think of these ETFs. Make sure to subscribe to our channel. Thanks for taking the time to watch this video today.